and that, of course, Bitcoin and now Circle, and of course, Coinbase as well, Robinhood, others are, SoFi, I know, is now moving back into crypto in a big way now that regulatory clarity is here.
Hey guys, welcome to Everyday Finance. The world's financial system is going through a major change that is quietly but significantly changing the basic rules of traditional investing. Legacy investment models are under more and more pressure as inflation stays high, monetary policies change, and people lose faith in fiat currencies. Bitcoin is no longer seen as a fringe asset or a speculative hedge in this changing world. Instead, nation-states and major institutions are using it as a strategic foundation for protecting their wealth. Michael Saylor is at the head of this movement, and his unwavering faith in Bitcoin is still what drives it. Saylor not only put an end to worries about another crypto winter in his most recent article, but he also predicted that Bitcoin will be worth more than $1 million. His prediction isn't based on hype, but on basic supply and demand, like the fact that only 450 new Bitcoins are mined every day and institutional demand is rising. MicroStrategy now has more than 582,000 BTC, which proves that he was right and makes the company a leader in the space. Cathie Wood of ARK Invest states that Bitcoin's price is only the most basic story. This adds depth to the conversation. Her argument is that Bitcoin is an important safe haven for savers and long-term investors alike in a time of high debt and slow money flow. Wood doesn't think of Bitcoin as a speculative goal, but as a necessary change to a system that is struggling to keep up. Together, their ideas show that money is changing in a bigger way, and Bitcoin is going from being an alternative asset to an important part of future finance.
The Bitcoin to gold, this uptrend has not been broken. Again, this aligns with the net bullish, risk-on kind of market that we think we're in. And I guess you can call the markets anti-fragile, which is a description used in Bitcoin. It's been able to withstand all kinds of turmoil, and we think the markets, the equity markets, are following Bitcoin in this regard. And I think there are two events that have happened in really the last week or so that suggest that risk on is where we are moving, and a market rewarding innovation. One is the Neuralink deal, and that was so oversubscribed. And you know, the animal spirits are alive and well, certainly in the private markets, but also in the public markets. The Circle deal, which we had been monitoring Circle for a very long time, and I do have a little story there. Jeremy Allaire, who's the CEO of Circle, he was at the World Economic Forum technology conference in 2016, as was I. We were both asked to do different panels, and we sat in on each other's panels. My panel in 2016 was about Bitcoin. And a company named TransferWise was there. I think it's since gone public, a fintech of the day. And more traditional financial institutions were weighing in on this topic. And there was one Chinese Bitcoin miner there at the time. Little did he know he'd be shut down early in the next year. But I'll never forget, we were the two Bitcoin advocates on the panel. And at the end of that session, the broadcast journalist who was moderating our panel turned to the audience, and we were in a round circle. It was definitely a round table, and there might have been 500 people there, and said, "Who thinks that Bitcoin is going to be around in the next 10 years?" And only one hand in the audience went up, and that was Jeremy Allaire's. So we definitely bonded over that event. So we are delighted and congratulate them for their amazing debut in the public markets this week. I think in the first few days, the circle is up 3 to 4-fold. And this gives us confirmation that animal spirits are back. And the fact that an apple could be down 18%, I think it is, this year, having really been the leader of the mega tech group, is forcing investors to take a look at other exposures to innovation that are maybe not in the Mag 6. And we think that is accruing to the benefit of, the next generation of innovators. So we're, of course, very excited because that's what ARK is all about, researching and investing the disruptive innovation today. So with that, I'll say in a very timely way, I can't tell you we did this on purpose, but we published our stablecoin white paper, Lorenzo Valenti's work, yesterday on Circle's debut day. So take a look at that. We think this is a very powerful movement. We think the financial services sector is going to reconfigure completely in the next 5 to 10 years. And that, of course, Bitcoin and now Circle, and of course, Coinbase as well, Robinhood, others are, SoFi, I know, is now moving back into crypto in a big way now that regulatory clarity is here.
The U.S. economy seems to be treading water, which means it's moving, but more slowly than before. On the surface, indicators show either small increases or decreases, depending on the set of data. But the real story is in the more subtle structural changes that are beginning to take hold. Federal Reserve Chair Jerome Powell has changed his focus from trade and inventories to core consumption and private investment. He has done this on purpose to avoid looking at things that are more volatile, like trade and inventories. Even though the headlines about the first quarter GDP didn't look good, Powell's preferred core metrics showed a 3% plus gain. What's wrong? That speed is already slowing down. In the second quarter, businesses are clearly taking a break because of economic and policy uncertainty, as well as higher costs. Capital investment is going down, and corporate spending is also going down. On the consumer side, people are getting tired. Companies no longer have the power to raise prices, not because they don't want to, but because they can't. Demand is falling everywhere, even in areas that were thought to be less likely to go down during recession, like consumer staples and luxury goods. At first glance, job market data seems solid, but when looked at more closely, it shows flaws. For example, participation rates are going down, and household survey data isn't always reliable. All of these things point to a labor market that is slowly cooling down instead of staying strong. Now, stagnation is more of a worry than inflation. The money supply stays the same, and velocity keeps going down, which shows that economic energy is waning. The fall isn't very dramatic. It's more like a slow erosion. Policy tools are getting close to their limits, so the challenge may not be keeping the engine running, but keeping it from overheating.
deficit as a share of GDP, not seeing any improvement yet. And Scott Bessent has committed to, where you see the X there, getting this to 3% as opposed to nearly 7% or 7.5% over this administration's tenure. And we think it's going to come about more through real growth accelerating, and we think that productivity-led growth will be very powerful in this regard. And of course, there are some efficiencies that are being built into this bill, however much Elon Musk does or does not like it. And the reason Elon does really focus on government spending is it is taxation, one way or the other. We're going to have to pay this through taxes now, taxes in the future, or the cruelest tax of all, inflation, inflating our way out of the debt. And if anything, we think deflation is where we're going here. And so this debt will be very difficult to service if we do go into a deflation unless unit growth really booms. And we actually think that's possible moving into 2026. So on the next chart, I mentioned corporate tax rates. You can see here, X marks the spot where the corporate tax rate would go if there was immediate expensing of equipment and structures. And you see, you have to go back really to the 40s, the late 30s and 40s, to see a lower effective tax rate. So that will be quite an accomplishment if and when it happens. Here you can see money supply. The growth rate has rebounded after nearly a year and a half of negative in terms of the level falling. And if you take a look at this chart, which goes back to 1960, you'll see that where we are with monetary policy now, or money growth, is at the low end of a range. The range was lower in the early 90s as Chairman Volcker and then Chairman Greenspan were trying to squeeze inflation out of the system. But other than that, it's rarely been lower than this. And if we're right that the velocity of money is slowing down based on all of the uncertainty out there, tariffs, tax bill, government spending, and so forth, then this I think the number is roughly 4.4% growth on a year-over-year basis, is lower than nominal GDP growth is right now. And if the velocity of money is slowing down, declining as well, that's going to be another pressure on GDP. So we do think we're entering the last leg of this rolling recession. I have no idea if we'll actually see another negative GDP quarter, but we do think the velocity of money is arguing against a very strong GDP growth.
A closer examination shows a more calm and resilient economic picture, despite the constant market noise and alarmist headlines. The US dollar is still trading close to the upper end of its historical range, not indicating a crisis, despite some media narratives that portray it as collapsing. Fears of inflation also seem exaggerated. Most commodities have stayed flat, with the exception of a notable gold rally. Instead of rising during periods of robust global growth, industrial metals have remained muted, indicating economic weakness, especially in China, where extremely low export prices, particularly for electric vehicles, point to a slow wave of deflation. Equity markets, however, continue to be remarkably stable. Major indices such as the S&P 500 remain resilient in the face of ongoing recession talk, tariff wars, and rising geopolitical tensions. The relative strength of the S&P suggests confidence rather than fear when compared to gold and oil. Even though declining oil prices are frequently seen with concern, They are serving as an imperceptible stimulus for businesses and consumers around the world, much like a small tax cut. There is a strong case for sustained, if uneven, growth when combined with improvements in productivity and innovation. Instead of collapsing, bond yields are progressively cooling, which suggests that financial conditions are normalizing rather than that there is systemic stress. The notion that markets are tested but far from broken is further supported by the fact that Bitcoin is still outperforming gold and is still in a bullish long-term trend. This consistent resolve across asset classes might be the most obvious indication of underlying strength in an environment that is ripe for volatility. It is debatable whether Bitcoin will hit the $1 million mark, but the fact that the market as a whole has remained stable despite pressure says a lot about investor sentiment and structural stability.